Welcome back all to Tech Tune-Up. I am your host, Paul Meeks. We get together every Tuesday morning, and I'm, of course, brought to you always by my friends at Benzinga, and also over my shoulder, my money management firm, Harvest Portfolio Management. What we try to accomplish here is retell some of the tech news of the week. However, give my spin on it, and hopefully it's actionable investment advice. Also, we'll talk about some of the stocks that I like very much. I think are fresh money buys, followed by my watch list. They're in the bullpen, getting ready to come into the game under certain conditions. Sometimes that's just valuation. And then I'll finish up with some tech trends. These are broader topics. And then if we have some time, which we typically do, we'll be together for about a half an hour, I'd be pleased to answer your questions. So let's get to the news of the week. Probably the biggest elephant in the room is Apple. Apple is in the midst this week of their Worldwide Developers Conference. Yesterday, we had the keynote address. I will tell you, bottom line, pretty underwhelmed. My problem with Apple for years now is they've shown no top line growth because 60% of their sales come from the iPhone, and that has been essentially stagnant in unit volume. Over the last several years, revenues only increasing just a little bit, nothing to write home about, based on increases in price. You can only go that far. So if you like Apple for its top line revenue growth, you better believe that AI is going to bring the mother of all iPhone upgrade cycles. So far, no good. And with the AI progress, or the lack thereof, that they announced yesterday at the conference, I'm not any more bullish. I'm probably less bullish. And then, of course, that's the story of the top line. The bottom line is even worse, because while we have a stagnant or slow growth top line, we have increasing tariff costs. Revenues flat to up only marginally. Very heavy increase in cost. That is the ultimate margin squeeze. And if Apple is forced to manufacture iPhones and other hardware here in the States with our high costs, you will never be able to look at that business model the same way again. And so we'll see what happens. Hasn't been on my buy list for eons. Next, this is interesting. There's a French company called Mistral, and Mistral has its own large language model. And this is interesting, not only for the European exposure, it's probably the biggest large language model for AI in Europe, but the plot thickens because a big shareholder is Microsoft. But Microsoft is even a bigger shareholder of Mistral's competition, OpenAI. So what happens with this love triangle in the future? It could get messy. Next, we're talking about OpenAI. Let's get at it. OpenAI announced the other day that this private company is already at a $10 billion annual reoccurring revenue run rate. And as I've said before, the way OpenAI has been valued in the private markets, particularly with its latest funding round, this company, if it went public and was popped directly into the S&P 500, it would be, of the 500, within the top 20 to 25 of America's largest companies by market capitalization. So stay tuned. They're obviously kicking ass over there. If and when the company comes public, it'll be in a monster, but the problem is they have a corporate governance issue. They started the company years ago as a nonprofit, and now they have a business segment under the nonprofit umbrella that is profit seeking. And so some of the purists say, well, we shouldn't be trying to rip people off and make big money because remember, our original mission was as a nonprofit. They won't be able to go public until they resolve this weird corporate governance. And so stay tuned. I imagine that's resolved by the end of 2025. Amazon is next, and Amazon is continuing its heavy AI infrastructure spend. They've announced they're going to give the good people in Pennsylvania about $20 billion, and also announced that they're going to build $5 billion of data centers in Taiwan. And Taiwan is very interesting because Taiwan, as you know, may be under threat from mainland China, not necessarily in the near term, but over the next couple of years. What happens? Because Taiwan is so important for American technology. So we'll see. I've talked a little bit about the momentum that I'm seeing in quantum computing. First of all, we have a pretty big merger and acquisition to talk about. IonQ has bought Oxford Ionics for $1 billion. You're spending $1 billion on a private company with not a whole lot of financial metrics yet to speak of. And so that tells you that people are trying to get into this arms race, and it'll get crazy over the next couple of years, just like the early AI infrastructure spending was crazy and continues to be crazy. Next, this is kind of interesting. IBM is a company that I have made fun of for years. This was your grandfather's US or global tech company. Well, the clock is always right twice a day, and the hands of the clock have moved around, and IBM, given its mainframe beginnings, actually may be, at least in the United States, the closest of anyone to bring us quantum computing at a large scale. And they expect to do this by 2029. I know 2029 sounds far off, but if this is actually legit, we will be placing our bets long before then. So, hey, you know what? Good luck to IBM. Love to see a comeback story. Next, I mentioned this last week, but I do think that this deal between Meta and Constellation Energy, which is a 20-year deal for Constellation Energy Group to bring nuclear power to Meta, could be a blueprint of what we will see in the future. However, I'm torn on the nukes because, yes, I do see it as a huge long-term opportunity. The problem is, even if you flip the switch and say yes to nukes, to get one of these facilities up and running is a multi-year task. So don't think beyond these announcements that we will be seeing revenues anytime in the next couple of years on these projects. So next, this is interesting. There is a European semiconductor company called STMicroelectronics. They are best known for putting their chips in industrial applications, particularly cars. Now, this company has just announced that they're going to fire 5,000 people. 5,000 people is a lot. And again, it's another proof point that I've reiterated in previous broadcasts that semiconductors might be well and good, but stay away from those companies that put their chips into industrial applications, particularly automobiles. If we have a recession in the United States, which I think that we will, even though it'll be brief and not so deep, General Motors and Ford are not going to be selling a lot of $45,000 four-door sedans. So stay away from this particular sleeve of the semiconductor industry. MongoDB had a very nice quarter. Stock went up a lot. Of course, the stock has been helter-skelter for years. You could never really just buy and hold this thing. It's too dangerous. But I would tell you, if you are going to make a bet in my technology sector, in what I call cloud-based data management, I'd probably go with the public Snowflake. And then there's another company that's probably second or even pushing Snowflake pretty hard. It's a company called Databricks. But Snowflake is public and Databricks, at least right now, is private. So next, Agentic AI. I'll get a little bit to this in the trends. Agentic AI could very easily take software as a service, which was how we delivered software in the 90s and early part of the 2000s, to the woodshed. I do not believe at all in the king of SaaS software, which is Salesforce.com, CRM, because this really upends their business model. So be wary of owning software, particularly enterprise resource planning software, and companies that deliver their software via the software as a service model, because they could be roadkill to AI and specifically agentic AI. In that space, I mentioned I don't like Salesforce.com, but I do own and do like at certain prices both ServiceNow and OW, and believe it or not, SAP from Europe. Next, we have a battle in the media between Reddit and Anthropic. Everybody knows Reddit, but we also have Anthropic, which is one of the large language models. And this will be a very interesting precedent-setting case because Reddit has the content, has a lot of connections with a lot of users, and Anthropic wants to use that content to train its large language models. At what point do we get to the part where there are going to be some serious, very expensive battles about who controls intellectual property? So far, with the evolution of AI, a lot of these companies in the AI space, because we don't have really any regulations yet, have gotten away with potential murder. And there might be a piper to pay at some point if they actually have to pay for this intellectual property, enter into licensing agreements with all these content sources. We'll see. CrowdStrike, you may recall that despite the fact that its data breach, its data outage in the summer of 24 caused the entire airline industry and other industries to shut down, it always had been, at least up to then, my favorite cybersecurity stock. It does have the best management team. But I will tell you this. I listened to their quarterly conference call live last week, and what they did to boost their results, because their results have been surprisingly good since that outage, is they had a special program where they paid very lavish benefits to lock in customers just when those customers were starting to doubt the product. So in the near term, you pulled in some sales, but here's the thing that's incremental that I worry about. It looks like the accounting for these client retention transactions has caught the attention of the regulators. And now they're looking specifically at their financial accounting for such. So you know what? No matter how much you like CrowdStrike, I will tell you, stay away until this is resolved. You never want to own the shares at almost any price of a company that's about ready to get bitch slapped for its financial accounting by the US or global regulators. Broadcom continues to be interesting to me. They had that nice quarter, but I've seen, at least in the commentary in the mainstream financial news, that people don't have an understanding of Broadcom, ABGO. Know that last quarter, 55% of Broadcom's revenues were semiconductors, but 45% is a software business. This is a very unusual hybrid business. And sometimes you would actually like the software mixed in with your otherwise pure play semiconductor company, because the software business has a 76% gross margin, and the semiconductor business, which is high for its industry, has a 57% gross margin. So the greater the software, the higher the profitability. And I must say that the driver within that semiconductor business has been AI, but it's not just AI chips a la Nvidia. A greater portion of their AI growth comes from their networking devices, their switches. Think of data networking as the plumbing of AI. Just like in the late 90s when the internet was being built out, Cisco was the plumbing of the internet with their data networks gear. So be wary. This is not a semiconductor pure play. And even within the driving force within semiconductors, AI, it is not a chip pure play. It has a big, big chunk, even the majority of its AI revenues, coming from the Tomahawk switch, which is data networking, not semiconductors, to build out data centers. So that's important because that stock has gotten a lot of news. However, I still own it. So next, Taiwan Semiconductor. Taiwan Semiconductor, probably the most important semiconductor company on earth. Maybe more important than Nvidia, because Nvidia almost exclusively depends on them for manufacturing their designs. The interesting thing about Taiwan Semi is, unlike US companies that only open the kimono and give you their financial results, particularly the top line revenues, once a quarter, we get revenues from Taiwan Semiconductor every month. And they just announced their revenues for the month of May. And May of 25 versus May of 24, up another 40%. So all is well in that space. And I read all the trade rags. One thing I will tell you is their next generation manufacturing technology, which is essentially imprinting chips with 2 nanometer feature lengths. When they go from the existing technology, which is ramped in 22 and has been the mainstream technology for TSM ever since, in the late half of this year, when they go to the new technology, they will demand over 50% price increase per wafer. So things look very good with Taiwan Semi. Of course, the only risk they really have is geopolitical risk, and particularly Xi Jinping, the premier of China, wants to take them sometime before he retires. We'll see what happens. So next, let's go on. OpenAI, I discussed. I think it's very interesting what the Saudis are doing in the Middle East. We know that Trump and company, when I say Trump, he brought a bunch of Silicon Valley CEOs with him. They went to the Middle East, right? They went to Saudi. They went to the United Arab Emirates. They went to Qatar, and they signed a bunch of agreements. We don't know if this is just, cameras and press releases. I imagine it's real. But I will tell you, Saudi's government has just funded a huge venture capital company. And so they are going to be making investments, typically in AI private companies, probably some quantum companies in the next couple of years. But this is a huge foray into the critical venture capital market by the royal family of Saudi Arabia. We'll see what happens. A couple days ago, I had a nice conversation with the management team of Catalyst Pharma. Catalyst Pharma is not typically in my wheelhouse. It is a pharmaceutical licensing company. It has nothing to do with semiconductors or hardware or software. But I tell you, I run screens. And when I run screens for investment ideas, I blast the entire universe of publicly traded securities. And only 4 or 5 came up recently. Some of them I've already talked about, like AppLovin was one of them, APP, already been on my buy list. But this company is a rather small cap company that you should keep your eye on. I like CPRX very much. I would own it. And I had a nice conversation with the management team just a few days ago. So Tesla is always going to be in the news, and that madman Elon Musk. But I will tell you this, today is the 10th of June. On the 12th of June, 2 days from now, they are supposed to unveil the robo-taxis in their test market of Austin, Texas. Now, it's only supposed to be about a dozen cars, and they're going to be in a geo-fenced area, so they can't get in too much trouble. But let's see what happens on Thursday. Will this happen? And if it does happen, what kind of fanfare? Then we'll start to take a look and see, do we have a chance for a epic Tesla comeback? Because right now in autonomous driving, Alphabet's Waymo has a huge lead, even in the Austin market. So we'll see what happens. I see an opportunity to add to 2 of my tech favorites. One is Robinhood. The other one is AppLovin, which I just mentioned, because here's the rub. Last couple of weeks, these stocks have been skyrocketing because it was assumed that last Friday night, they would be announced that they'd be included in the S&P 500 index. Well, after the close on Friday of last week, the S&P organization made their picks, and they actually made no additions to the index. And so they snubbed both AppLovin and Robinhood. And because investors were buying to prepare for that, right? Because if you're named to a index like the S&P 500, you're going to trigger a lot of index buying. You want to get ahead of the big price move. Well, unfortunately, of course, the stock's reversed. And I will tell you, Robinhood's come down a bit, but AppLovin's come down more than that. I think I'd keep Robinhood in your mind to potentially buy on further weakness. And I'm liking AppLovin right here, right now. And it's all based on, not on fundamentals, but on, the S&P 500's decision. So let's move on and get into, some of my stocks that I like and others not so much. I'll be briefer here because I don't have a lot of changes. Here is my fresh money buy list in green. If you can't read it, if you need it elsewhere, just contact me and my friends at Benzinga. But I've told you many times, bar none, my favorite stock, and I do think it's a opportunity after the snub by S&P 500 last week, is AppLovin. I'm in at 384. I could have bought it even lower. Actually, right now, we're hovering around that. I'll be honest with you. I have a buy limit order in for 376. So that tells you what I'm doing. Take-Two Interactive. I like gold as a hedge. And so I like Royal Gold instead of owning the GLD or any other gold ETF. I told you in enterprise resource planning, I can actually be bullish on, not the stalwart here in the United States, Salesforce.com, but ServiceNow, which is an American company, and SAP. I like Boeing. Boeing is announcing some big orders. It really surprised me because I thought they were going to get their asses kicked with these tariffs. Of course, that's not resolved, but they are getting some good orders nonetheless. You have to give a lot of credit to the CEO that they brought in less than a year ago to turn around that company. Some early improvements, some early gains. I told you about Taiwan Semi, huge 40% growth in their chip sales in the month of May. I hide to be defensive in several of the drug distributor names. Meta, Microsoft, Nvidia, Lyft is fairly new for me. I like Lyft because of its valuation to Uber, which I already own. And Uber, of course, has done quite well. But Lyft has some low-hanging fruit. And they also had a nice catalyst for change with a rather new CEO who has done some good things. Because before he arrived, that company sucked. They had a nice opportunity. But Uber was so much superior than Lyft. Now, maybe if we close the gap, there won't be much movement in Uber's price if they close the gap. But there could be a lot of improvement in Lyft's price. Snowflake, I told you, in cloud-based data management, I like Snowflake, the public company, and I like Databricks, the private company. I imagine that Databricks will not let this PR go to waste, and you could expect Databricks to go public in the next year or so. I very confident of that. Intuit, like their quarter. Anyway, you can see the rest of the list here, and let's take a look at the yellows, which are my awaiting list. More of the same, as I mentioned, not too many changes. I will tell you that I don't want to say anxious. I'm never anxious about this kind of stuff, but I am most bullish when I take a look at the stocks that are either on my fresh money buy list or here waiting in the bullpen in yellow. I want to buy more AppLovin. I mentioned it. I want to buy more Robinhood. I mentioned that. And to be perfectly honest with you, I bought some more Netflix this morning, and my buy limit was 1194. So today we had a lot of news in I like to call it the old school media. So Disney announced that they're going to throw another $400 or $500 million at Comcast to buy the 1/3 or finish buying the 1/3 of Hulu that it didn't already own. Paramount announced a 3% layoff. When you hear Paramount, think CBS. And you have Warner Brothers Discovery, which when they merged Discovery Network and Warner Brothers, they talked about these wonderful synergies just a couple of years ago. Well, now they're unbundling the whole thing. It has been a colossal failure. And so you're going to have Warner Brothers, and it's going to be two different companies. One is the linear or legacy media, and the other is the streaming. In every case, what do? Streaming might be okay, but if you want to be in streaming, just hold your nose and keep buying Netflix. Do not buy a share or hold a share of anything that is a pure play legacy or linear television company, because it will go to zero over time. Bag of shit. So remember, sometimes we have these interesting trends that dovetail nicely into some of our picks, as they always should. So let's get into, as I said, some of the tech trends and things to watch for more broadly. All right. Got to watch rates if you're a tech investor, or otherwise an investor in aggressive growth stocks. Rates go down, those stocks go up, and unfortunately, vice versa. So this is kind of interesting that it looks now that the Fed may lower rates at the September meeting. The last time we got together, the CME FedWatch tool was telling us that they weren't going to do so until the October meeting. And that October meeting was set to be almost at Halloween, at the very end of the month. So there is zero chance that the Fed is going to do anything with rates at this meeting, which is going to happen next week. There's close to zero chance nothing happens in July. There is a decent chance in the September meeting that we will lower rates 25 basis points or 0.25% for the first time in a long time. Of course, we have a very big news event, which could upend all of this between now and then. And that is essentially when the 90 days of delay to implement the tariffs on the Chinese and others wears off. So think about that. That's going to go down in the first or second week of July. And if we have some deals struck, and it looks like a win-win for all, could continue to lift the market, which has come back from its April lows and is almost back to its highs. But if we don't have deals, or if the deals look to be unsatisfactory, we could have another bitch slapping. Because remember, on Liberation Day on April 2nd, over the next week, the only thing that happened is investors were liberated from their money. So anyway, we'll see how it plays out. As I said before, I mentioned some of the M&A activity in quantum. This is very interesting. We have M&A activity, and these are not small deals. The one I announced today, $1 billion transaction for essentially a pre-revenue company. And then, of course, we have this big announcement from IBM that they're going to figure this shit out. And this is going to be a big opportunity for them by no later than 2029, 4 years away. So I write research for a company called Water Tower Research. And I just started with them because I used to be a college professor and I retired from that in May. I think that I'm going to cover a bunch of companies, but I may want to write about the quantum companies so I can be early in the market and I can be known on Wall Street as the quantum guy. That might be a good thing to be known for. So stay tuned. I told you that I am very worried that what we call Agentic AI will take some of these traditional software companies, particularly companies like Salesforce.com and enterprise resource planning software, to the woodshed. I think it's a major scary trend for them and a few of the others. As I've said before, even though I am hoping that we resolve this tariff crisis and we don't have a Armageddon type situation in July when all this stuff is supposed to go live, I still think that so much damage has been done with the back and forth with the Trump administration that we will not be able to prevent a recession. So we will have a recession in the United States, in my opinion. It won't be very deep. It won't last very long, but it could, if we don't get good news between now and July, that would be the catalyst. So I tell you, You see all of my stocks that I pick. I am so upfront with everybody. It's ridiculous. I'm on the verge of probably getting slapped by the regulators for that. But I would keep a cash hoard or spend your cash hoard very slowly and deliberately, because we could easily have another couple of rough weeks like we did after Liberation Day on April 2nd, where the 4 trading sessions after Liberation Day, the S&P 500 went down 12%. And the NASDAQ, which is where all these aggressive growth stocks are, went down much more in 4 trading sessions. So with that in mind, let's take a couple of questions if you have any. Sure, you don't love Qualcomm's industrial exposure, but their spot in Internet of Things and PE look very attractive. I will tell you a question about Qualcomm. Qualcomm, I was there when they got rolling. I was one of their bigger investors when I ran the tech money for Merrill in the 90s. I would say that Qualcomm is starting to generate some respect. I think that you might have to wait a while for Qualcomm to show its revenue acceleration, because only then will you have the big move. But it is, at least compared to other AI derivative plays, other companies that are least indirectly impacted by AI, it is relatively cheap. So, if you own Qualcomm, I'd probably hold it. I don't know if I would chase it, but maybe continue to build your position on weakness. And right now, it's not on my dream team AI-related semiconductor list, but I usually prefer momentum names where everything's going right. Occasionally, I will dip into a relative value situation. And so Qualcomm is something, I must admit, I have been sniffing around the last week or so. All right, guys, we will see you next week. Stay tuned. Always big stuff happening. It used to be just company specific or microeconomic focused. Unfortunately, over the last year, everybody has had to put on their big picture macroeconomic hat, especially with Trump 2.0. But if we have volatility, it's actually awesome for us, because volatility brings some great trading opportunities in the least. So we will see you next Tuesday. Thank you.